Hey everyone, welcome back to Corporate Decoder. Today we are diving into a 10K, which is an annual report filed by Cherry Hill Mortgage Investment Corporation. Don't worry, I won't bore you with all the details. I'll try to extract what's interesting in this filing. Let's see if this Cherry Hill is a sweet investment or a sour deal, shall we? This is their annual report, basically a year in review for 2024. It gives us a good look at how the company performed, what they're betting on, and what could go wrong. The report starts by telling us the company's public float, that is the value of shares held by people who aren't bigwigs or insiders. In June of 2024, that number was around $108.4 million. This gives you a sense of the company's relative size. As of March of 2025, there were about 31.6 million shares of common stock floating around. That's good to know for calculating things like earnings per share. Before we dive in, let's decode the key terms this company uses all the time. Things like agency RMBS, which are mortgage-backed securities issued or guaranteed by a U.S. government agency, excess MSR, or interests in mortgage servicing rights, and of course REIT, or real estate investment trust. But before we get to the juicy details, there's a cautionary note about forward-looking statements. They're basically saying, hey, we're making predictions, but things could change. This is standard stuff, but important to remember. They talk about everything from their investment goals to potential interest rate changes. One of the biggest changes for Cherry Hill was something called the internalization event. Basically, they used to be managed by an outside company, but in November of 2024, they brought all that management in-house. That's a big shift. The company's strategy involves two things: RMBS, or residential mortgage-backed securities, and servicing related assets, which are assets that are from servicing mortgage loans. A big move is their strategy to allocate a substantial portion of their cash to acquire MSR, or mortgage servicing rights. The RMBS strategy is particularly interesting as they tend to invest in what they call TBAs, to be announced forward settling agency RMBS, where the pool is to be announced. In simpler words, they agree to buy a type of mortgage bond at a future date, but the specific bond isn't picked out until just before the deal goes through. If they need more cash, they might sell more stock or borrow money. The board can make these decisions without asking stockholders, which is something to keep in mind. They are in a very competitive business, going up against other mortgage REITs, banks, and even the Federal Reserve. Many of these competitors have deeper pockets. One of their big risks, relying on other companies to actually service the mortgages they own. If those companies mess up, Cherry Hill could be in trouble. Also, if interest rates go haywire or people start paying off their mortgages faster than expected, the value of their investments could take a hit. In this digital age, cybersecurity is a concern. Their business is highly dependent on it, and any data breaches could damage their finances or reputations. They use leverage, which is like borrowing money to invest. This can boost returns, but also magnify losses if things go south and they are forced to meet margin calls. Remember that management shakeup? Well, legal issues related to terminating that old agreement could cost them money and create headaches. The REIT structure they chose has pros and cons. It helps them avoid some taxes, but also limits what they can invest in. Alright, that was the business overview and the formal stuff. Now for some financials. For the year 2024, they're showing a profit after taking a loss the previous year. The numbers here are quite swingy. There was a big unrealized loss of $19.4 million on RMBS, which means their value went down because of market conditions. Offsetting that, they managed a realized gain of over $21 million on their derivatives, basically bets they made to hedge against risks. General and administrative costs went up significantly, which is likely tied to the cost of that management overhaul that happened in November 2024, costing about $4.3 million more. They've been selling off common stock. During the year, they've managed to get $5.6 million in that way. They have been repurchasing preferred stock, which resulted in a gain attributable to common stockholders of $78,000. They admit that they can't predict what the Federal Reserve, the Fed, will do with interest rates, and those actions could really shake things up. The Federal Reserve might start cutting rates or raising them as well, they simply don't know. Talking about their MSR, or mortgage servicing rights assets, their values go up and down depending on interest rates and prepayments. A risk, they rely on computer models to make decisions, and those models might be wrong. This could lead them to buy the wrong assets at the wrong prices. And as an important note, when owning assets that need servicing, the company has to keep data protected. They are sharing data with a third-party company servicing them, and any cyber breaches could be costly. Currently, there are no major legal headaches looming. This is always good news. Lastly, a brief check on any errors. No accounting errors were found that needed correction in this report. Now, zooming out and looking at Cherry Hill as a whole, where are they headed? It's a mixed bag. Their move to bring management in-house could pay off in the long run, saving them money and aligning everyone's goals. But the legal risks of the old management agreement are still there in the background. They're playing in a tough sandbox, going up against bigger, richer companies. Plus, those shifting interest rates could really mess with their returns, depending on how well they manage their hedges. I'd say Cherry Hill is one to watch, but not one to blindly jump into. Keep an eye on their ability to manage those risks and capitalize on the new internal structure. If they can navigate these challenges, they might just deliver that sweet return they're promising. Thanks for tuning in to Corporate Decoder. Don't forget to like, comment, and subscribe for more deep dives into the world of finance. What company should I decode next? Let me know in the comments.